this seems new to you. It really shouldn't. You did this in your stats class, so I'm not showing you anything radically new. The problem is you're seeing it in a different format, but really finance majors should be really comfortable using the normal curve and answering questions. Really should be second nature. So if you haven't seen this, I would learn it really fast. We did this kind of stuff at USAA all the time. It's real simple stuff, but it does answer some questions quickly and give you some insights. So your boss has this new portfolio. Their risk budget's 15,000. Their portfolio is 225. So here the budget is in dollars, but we're calculating the VAR in percents. But it's real simple. Once you get to VAR, you just multiply it by $225,000, and it's pretty straightforward. So we said 1.3. What do we look for in the table? You don't see 0.013 in the table anywhere, do you? What are you going to look for? Yeah, 1 minus that, so which is what? Plus 1 minus 0.013, 987. So you go find 987. It's somewhere around here. I usually go one extra. I go to the higher one. You don't need to interpolate. 2.23. So 2.23 represents, you look at normal distribution, you go that far from the mean. That happens, you're to the right 98.7% of the time, you're to the left 1.3% of. Y'all remember doing that in stats? Does that seem familiar? I'm getting a bunch of dead stares. So you really should know that. It's pretty common in finance to do that. So our VAR of 1.3% equals our mean 6% minus the 2.23 standard deviations times the standard deviation. That's 11.84, but again, we always just state it in absolute terms. So in dollars, it's going to be our portfolio, 225,000 times 11.84 is 26,000. Our budget was 15,000. So it's too risky. Then I asked what risk tolerance could accept this portfolio. How many standard deviations is 15,000 from the mean? So your mean is 13,500 because your portfolio is 225,000. Your expected return is 6. So 50% of the time you expect me 13,500 or more, or 13,500 or less. So how far is that loss from the mean? So you take 13,000 minus 15,000. That's what your loss would be. That's what your budget is, right? What is your budget allowing? So 13,000 minus 15,000. So your budget is 28,500 from your mean. So we're asking, what's your probability of you being $28,500 from your mean? Your mean's 13,500. You're worried about losing 15,000 bucks. That's 28,500 away. That's 1.58 standard deviations. 1.58, 1.58 plus 1 minus that. So the mean minus that equals that. So what is the risk tolerance? 5.5571. You must subtract that value, so you get that 571. So there's ways to go back and forth. So he has a risk tolerance of 1.3%. His risk tolerance would have to increase to 5.571% for him to accept this. That's a pretty high risk tolerance. If he's gonna have to accept a lot more risk. Let's do the exam questions because that's probably what you're more interested in. But you do have answers here. We might work a few more of these if we have more time. Some of them are fairly interesting. Some of them are a little macabre because I'm talking about, yeah, one of them is a little weird, but that's all right. So let's look at the ones that are more similar to the exam. I'm going to start at the bottom because these are actual previous exam questions. So this is exam 1, really straightforward questions. Your client has a portfolio, has an expected return of 4%, a standard deviation of 5%. Your client's risk tolerance is 0.25%. Again, what do we do there? Do you go right here? No, what are you looking for? You're looking for how many standard deviations is 0.25%. So you take 1 minus 0.0025, right? The risk tolerance is 0.25%. Make sure you convert percents into decimals. So 0.25% is 0.0025. You take 1 minus 0.0025, that's 9975. You go find that one. Right there, 281, 2.81. Everybody understand that? If I give you the risk tolerance, you're looking for how many standard deviations it is, but the risk tolerance is going to be in terms of the left side of the tail, but the table is giving you to the right, so you have to take 1 minus that. So we're looking for a 2.81 event. So your risk tolerance is going to equate to a 2.81 sigma event. So your VAR is the mean. Your mean was, this doesn't say mean, does it? Expected return and mean are the same thing. So, and if it's a normal distribution, the mean, the median, the expected return, they're all the same. Why do we call it expected return? I don't know. How often do we expect to make exactly 0.04? Never. So think of it as the middle value. 50% of the time, we expect to be higher than that. 50% of the time, lower than that. So we take the mean minus that risk tolerance number of standard deviations times our standard deviation. That's 10.05%. What was the budget? 12%. So they get a positive score. And do people do this? Yeah, there's a lot of prop desk people that use this type of approach to check every day. They tend to get their standard deviation like from trailing 100-day numbers. A lot of your banks do that as well. So it's somewhat sensitive to a major shock to the system. So you'll have a question like that on exam. That should be a give me question. A hedge funds long short equity portfolio. You don't care about any of that. It doesn't affect your answer. So what's a long short equity portfolio? You know the difference between market neutral and long short. Anybody know the difference of those two? Long short is what? So you might be 100,000 long on stocks and maybe 30,000 short on stocks. So you have a $70,000 portfolio. Long short means you have more long positions than short positions. Market neutral means what? You have 100,000 long and how much short? 100,000. So there you're completely matched. So this is a long short portfolio. It's going to have a little bit more volatility than a typical portfolio. Its expected return is 0%. Why? Because it's daily. I've had students freak out on an exam because they practice so many daily ones. If it's daily, you still type the mean in there. It's 0. If it's not daily, you type the mean in there. So it's always the mean minus the number of standard deviations times the standard deviation. Don't let the fact that the mean is 0 throw you off. You still type in the mean. So most of your banks are doing daily valued risk. So that means the daily VAR is 0. I mean, the daily mean is 0. At USA, we did annual things, so we didn't have that 0. But here it's 0. Their risk tolerance is 2.5. Someone's tell me what number we're looking for. 975. So plus 1 minus 0.025. 975. There it is right there. I do try to find round numbers so that you don't have to panic that it's not in there. But so 2.5%, one of those that has a round number. So how many standard deviation event is this? 196, right? 1.96. Your budget's $35 million. So Your risk tolerance associates with 196. So your VAR at 2.5% equals 0 minus the 1.96 number of standard deviations times 3%. That equals 5. Notice here, I didn't even type the negative number. It's not that it's a math error. It just, to me, it's always gonna be a loss. You could type the negative number if you wanted to. You take that number times 700 million. Where did I get that? That's the portfolio value. 700 million. Easy 41 million. Did they pass in this case? Their budget's 35, so they fail. They're out of compliance. Uh-huh.
When a company fails to evaluate a risk, like it's greater than budgeted risk, what do you do about that?
Well, they got to reduce the risk somehow. So they have to look at the portfolio and figure out maybe it's too leveraged. They're going to have to reduce the short positions or do something to somehow hedge it. But yeah, you have to take less risk. They're actually pretty good at doing that. One of the hedge funds I use at Deutsche Bank, they said, name your standard deviation, we'll give it to you. So they had a 1-in-1 fund, had a 1% expected return, 1% standard deviation. And I said, I want a 20-20. So they said, okay, we'll do it. We'll leverage it up. So 20% return, 20% standard deviation. They built it just for us. They had a fund, but they built one just for us. And then they called and said, someone else wants that fund. Can we let someone share with you? I said, yeah, sure. Their hedge funds are really pretty good at exactly getting the risk where they want it. That's part of what they are. There are a lot of engineers, right? Mathematicians, so they can get it. They would never be out of compliance because they're quite precise. This. All right, a pension plan, $2 billion portfolio, has an expected return of 6%, a standard deviation of 10%. Their risk tolerance is 1.5. Someone just tell me what am I looking for? Yes, we're getting really good at this. +1 minus 0.0 what? 1.5. 985. There it is. So what is it? 217, 2.17. So in all calculations, what is your VAR? So there's your 217. So 6% expected return minus 217 times 10%. Again, you can put the negative sign, but you don't, on these problems, you don't. So when do you need a negative sign or not? When you're calculating the VAR, don't use negative signs. When you're trying to figure out the probability of something happening, you have a target. So when you're starting with the number on this side and you're trying to figure out the probability, positive or negative makes a big difference. So if they say, what's the probability of 28% loss? Then you have to type negative 0.28 equals. But on VAR, when you're calculating the VAR, it's in absolute terms. We know it's a loss. So 15.7 times $2 billion equals 314. Did they pass? They failed here. All right, so now we get an example problem. You're ready? This is the one. I think 80%, 85% of students get 100% on these three, and 85% miss this one. Let's see if this class can fix it. All right. So first of all, in this question, they're not asking for a VAR. They say the pension plan is currently underfunded and needs to make at least 15%. Get into balance. What's the probability they make 15%? Anytime you say, what's the probability they'll do something, that becomes your target. And your target equals the mean minus the number of standard deviations times the standard deviation. Up here, we had the mean, we had the number of standard deviations, and we had the standard deviation. Here we have the target, we have the mean, we have the standard deviation. What are we missing? We're missing that. That's the piece we're trying to figure out. All right, so what's our target here? And is it negative 0.15 or positive? Positive, all right? They're not asking what's the chance we lose 15%. They're saying what's the chance we make 15%. So they need a positive 15%. Our mean is still 6%. That didn't change. We don't know the number of standard deviations. The standard deviation is 10%. So you just multiply that across. So you get 0.09. equal minus the number standard deviations times the standard deviation. And that's why whether it's a positive number, negative number is so important, because you want to know how far it is from the mean. 15% is only 9% from the mean. Negative 15% is 21% from the mean. So that's why it's really important when it's a positive number or a negative number. After this point, it doesn't really matter if it's positive or negative, but that 9% is really important. How far is that from the mean? Y'all see that? Minus 0.15% is 21 from the mean. Positive 15% is 0.09 from the mean. So it's the positive or negative is really, really important. So times 0.1. So you divide both sides by 0.1, you get 0.9 equal the number of standard deviations. And then you find the point. Well, 0.9 is actually what you're looking for, right? But the number of standard deviations, so 0.9 is 8159. So we find this in the table. I mean, this is the number of standard deviations, right? So we're looking over here in the table. So make sure you're careful. The table, the outside of the table is the number of standard deviations. Inside the table is a probability. So here we have the number of standard deviations. And it's the fact that it's a negative number means we're looking for 1 minus that. All right, so it's 0.8159. I just forgot what I just said. 8159. And here's where you use logic. Their mean's 6%. What's their probability of making 15%? Is it 82% or is it 18%? What would be most logical? They expect to make 6. They're asking what's the chance of making 15? Is that a 82% chance or it's 18% chance? 18, all right? So the probability is going to equal 1 minus 0.8159. How do we know it's 1 minus? Because it's the negative number. So whatever that is, they've got about an 18% chance of making 15% or more. You've got an 82% chance of not meeting their target. All right. Everybody I can see a lot of people are like, what do you just do? So it really is good to get used to going back and forth from the normal table. I'm sorry, normal curve would be a little easier. So we expect to make 6%. We're hoping to make 15%. How much, what's the sum of all the probabilities underneath this? 100%. Everything to the right is 50%. So 6% is we're gonna be below that 50% of the time, above that 50% of the time. But we're asking about 15%. 18% of the time we'll make more than 15%. 82% will make less than that. You just get used to using a normal table. If you ever read Taylor, we'll talk about Taylor later. One of his biggest complaints is our overuse of the normal table. But why do we like the normal table? Because the math is so easy. We can do really quick calculations really fast, where we can't do that with other type of distributions. So we like it. Questions on that? I can tell some of the room are like, yeah, I don't know what he just did, but all right, we'll practice some more. All right, y'all do this one. And y'all tell me the answer. I'll put the normal curve up. The first person get it right gets $10,000, unless I change my mind later.
So you said that just looking at the mean of 0.06, you were able to tell that.
Well, it has to be less than 50%. right? To be to the right of the mean, you know, make 15% or more, you know, it has to be less than 50% because 50% of the time you make 6% or less. So you know it's got to be less than 50. If I'd ask you, what's the probability they don't make 15%? Then that's 82%. So you have to look at how it's questioned.
Wait, are you getting to it? Or what if the curve was scaled up? You know what I mean? What if the,
Well, we're using a normal curve, so it's perfectly symmetrical. There's no,
what I'm saying, like the range of one standard deviation. Like what if, I don't know how to phrase this question, but
all right, work this problem and then we'll try it. You know, think through it. Just
What if your returns were just like not on the normal distribution?
yeah, if it's not normal distribution, you have to use different type of math. There are other distributions. There we have actuaries in here. They use a lot of other ones, but we tend in finance to overuse normal distribution. We know the U.S. stock market is almost normally distributed, except for in the tails, especially the downside. There's a higher probability of the downside than the normal distribution would say.
So fatter tails?
Yeah, fatter tails, especially on the right. But if you were to put the returns in the S&P 500, it's going to look like a normal curve. It's got a few little bumps in the corners, but shape looks pretty close. It's more log normal because you can't lose more than 100%, but it is, so it's a little skewed to the right. So, right. Here's the table, so you can get the table value. I don't know which table value you need. Tell me when to stop. Do you see what you need? Tell me. I guess I should look. Is that good enough?
0.983,
0.93?
0.983.
Oh, 98. Okay. All right. Y'all got it?
Yeah. I don't know why. Can you go back for 1 second?
1 second. Yeah.
Thank you.
That was more in a second. Huh?
I'm looking at, I'm able to execute it. What I was trying to say.
All right.
What I was trying to say is like, if the mean is 0.06, couldn't it potentially be more likely to hit that, 0.15, given like a wider range of data? I'm saying that, can an old distribution cover a wider range of data?
I'm not understanding you. I mean, if you
So
believe
like-
the mean is 6% and the standard deviation is 10 and it's normal distributed, 18% is the right answer. If you're questioning if any of those are false, like the standard deviation is really greater than that, or there's some hidden, yeah, you have to throw it all out. Once you say it's not normally distributed, then yeah, throw the whole thing out.
But the likelihood would change with the standard deviation change.
Yeah, if I think I even worded it that you think that you believe that the standard deviation is this, so there's some uncertainty there. Yeah. If the numbers are wrong, then the calculation is gonna,
I got a negative number, but is it 24.84%?
I don't know, we'll have to see. I mean, remember, if it's a negative number of bars, you just say it, you use absolute value.
They're over their risk budget because it's 18%, but they ended up with a value at risk of 24.
All right, let's try it. Let's see. So the VAR of 1.7%. What was the mean? 6. How many standard deviations?
2.12.
And the standard deviation?
Well,
And what did y'all get?
0.2484.
22.
2484.
All right. What was their budget? So did they pass? I used to jokingly say fire the CFO, and then students started writing out on the exams. So you don't really know if you're going to fire the CFO. It might not have been her fault. It might have been the finance guy she just hired. But everybody get that? These are pretty straightforward questions. There's nothing tricky about them. Now, sometimes I will say the portfolio's notional value. So if you see me say notional value, that doesn't change anything. So it's true if that's a notional value, they don't actually have that much money invested. What the notional value is telling you is that's what you apply the numbers to tell you what your risk is, even though you may not have that invested, because that's how you lever it up. So don't let the word notional value, whatever the value is, whether it's actual value or the notional value, that's what you apply these numbers to. All right, so work that one out. All right, y'all got the table value you need? Just
In a higher rate environment, it's a bit easier, how would you get the swap that you want? Like, if you want to do a swap. And you're in a high rate environment.
it shouldn't make it more difficult. I don't think liquidity. No, there were some liquidity issues during a crisis, but not really related to that level interest rates. Swaps have a lot of liquidity on both sides. All right, y'all got your number, everybody? Is that far enough down to see it? So here are the budgets in dollars, so you have to convert it to dollars. But don't let that word notional throw you out. All right, any takers out?
Our mean is 0.
So 0.
0 minus our standard deviations are 1.67.
And say it real, because I do that too. So always say the number of deviations, so you keep it really clear. So yeah,
Times the standard deviation of 0.13.
113. Okay.
And then once you put those against each other, you get your percentage form, which is 0.02171.
Everybody agree with that?
So 2.17%. And then you just multiply that by your 20 million. And then
Not 20 million.
or 20, whatever the risk budget of 20 million.
No. Multiply by what?
Oh, they're
900. Yeah. And how much do you get?
19.5.
That looks about right. Does that look right? 19.5. So did they pass? They passed. Yeah, always be real clear, the number of standard deviations and the standard deviation. When the accountants at USA call to get the numbers, they would always say, what's the standard deviation? It's like, well, it's 10%. It's like, no, that number, the other standard deviation. It's like, I was always really picky. Tell me exactly what you want, because I wanted them to be really clear. They were asking for this number, but they were saying standard deviation. Always be really clear. This is a number that's related to the normal table and your probability. You might say it's a some people will say a 1.67 sigma event, that kind of thing. All right, that look right? Everybody got that number?
I think I got a different number on the first question.
Oh, really? Anybody else get 20?
Yeah, I got that.
19?
For operations issue.
19? Anybody else confirm that one?
Yeah, that's what
Okay. Did they just forget to subtract it from 6? All right. All right, another easy one. Part A, you have a pension plan, $4 billion. Expect to return 5%, standard deviation of 8%. Pension plans are almost always going to be annual VARs. They're not going to be daily. Banks are really the only ones that do daily. Their risk tolerance is 0.8%. Got your number? 0.8%. He's got it. All right, well, let's work it out then. Risk tolerance was 0.8%. All right, what's our mean? 5. How many standard deviations? Standard deviation. All right.
Wouldn't it be under zero? Is it, I don't know.
No, that's the tolerance. Yeah. What'd you get?
14.6.
Yeah, I recommend on the exam, ignore percents and just do everything decimals. It's a lot safer. So anybody else get that? 14.8? Not getting any yeses at all. So no one else did? Okay. All right, so what's your VAR in dollars? Or you don't need it in dollars, do you? Or do you? Oh, risk, yeah, $500 million risk budget. So what's their VAR? What do we multiply by? 4 billion. And what do you get there? Like 300 million or so. How much is that? It's over 500 million. How much is someone got that number?
Not 571.
All right. So it's a fail. So when you see a problem like this, first of all, where did they get the mean from? The mean could be the historical return, which is really dangerous. If you had a really strong bull market, it's gonna be overstated. You'll see in your project that we're gonna do later in the semester, the mean's gonna come from forecasts, what we think is gonna happen in the future. Standard deviation is almost always based on history. You just have to pick which period you're gonna use. The last 3 years, the last 10 years, the last 50 years. And then your risk tolerance, that's subjective. It's your opinion. How conservative do you want to be? But we'll talk about that when we talk about the project, because we'll have to make those decisions. You'll have to make a decision on all three of those. Uh-huh.
Can you show us where we're supposed to look on the table?
So you're looking at, I'm sorry, 0.08. So what are you looking for? 0.992, right? 992, is that right?
Oh, okay.
So 2. Yeah, be careful with decimals. You don't lose 100% if you use 8% instead of 0.8%, but you'll definitely lose some points. I suggest if the risk budget is 500 million, you come out with 23 million, that you might have a problem with decimals. So go check it. I usually don't make it that radically different. How would they fix this situation? What's the most logical thing? We've been talking about pension plans. What's the most logical thing they can do? Reduce their stock allocation, increase their bond allocation. It'd be the easiest thing to do. They could do that pretty quickly. Yeah, I mean, it's amazing how much money you can move around. Most of the time, this stuff is very liquid. All right, so this is very similar to the previous problem. So here they're asking, it's exactly the same problem as the last one. So they need to make at least 18%. Write this one out, see if you can remember from the previous problem. I won't show you the problem, but write it out. It's the same formula, except for this time you're given the left-hand side. Don't go to the table until the end. I want to get the number first, and then we'll go to the table. All right, so someone give me the whole formula before you simplified it.
18%. 0.05%. Or, yeah, 0.05 minus 100% deviation. Times that 0.0, yeah.
Okay, number of standard deviations equals what?
Versus
So
so 0.13 divided by 0.08.
0.6263. Is it 62 or 63?
6.3 to round up.
Yeah, here, I don't know if rounding up is what you want to do here, but you could. 1.63. Now, where are we looking for the 163? That's the number of standard deviations. So that's on the outside, 163. You get 9484. Everybody see that? 9484. What's the probability? That was if it was a positive number, it's a negative number. So what's the actual probability? Be 1 minus that, or 0.0516 or something. I don't know. Someone tell me what's the number?
Yeah.
So they've got a 5% chance of making 18% or more, but they actually have less of a chance than that. And why is it? Because what happened up here? They failed. So what are they gonna have to do? Take less risk, less returns. So it's actually, they have less of a chance. How could they have more of a chance? Take more risk. Right? So if they really need to make 18%, say forget our risk budget. Let's put everything in emerging market stocks and we'll have a good chance of making 18%. So
Is that like what you were talking about, the states doing with their pension plans that are under?
Well, what they do is they exaggerate this number. I remember we had this firm, I don't know how much we're paying them, it was an executive firm helping execs with their retirement. They were assuming that cash could make 9%. It's like, I don't think cash can make 9% because money markets are paying 3-4%. Said, no, that's the average of the last 15 years. And yeah, that's the 70s and the 80s when interest rates were double digits. But they're telling their clients assume they can make risk-free returns of 9% when the treasuries were at 5%. And I was like, yeah, I don't think they're gonna make 9% risk-free. But yeah, you can solve a lot of problems if you use a really exaggerated return. You're just gonna find out later that it's not gonna happen. I actually had that debate with the CEO of USAA. It was before he was CEO, but he wanted to say bonds are gonna make 8-9%. It's like they've made that because interest rates have fallen. For bonds to make 8-9%, when interest rates are 4%, interest rates almost can't fall enough to give you a 9% return. So I don't think that's a good assumption. He didn't like me after that, but I retired before he was CEO, so it didn't matter. All right, everybody see that one? There's a few other ones up here to practice with some YouTube videos. I don't know where I get these names. Usually it's somebody I find in the news. If you see it's the ABC pension plan, and I just was too lazy to go find a name. I don't know who that is. They have a derivatives operation with a portfolio of derivatives valued at 1.2 billion. Notional value, you don't really care that it's notional. They don't actually have that much there. Remember at USA when I did the swaps, the notional might have been $3 billion, but the market value was 0 when we started. So the notional is really where your risk is. So that's the important number. It's given a daily risk budget of $75 million and a risk tolerance of 0.3%. With an expected daily standard deviation of 2.4% and a mean of 0. So it's the same problem over again. So work through that one. Let's see, the risk tolerance 0.3%. I'll give you a few seconds to find your number. 0.3%, not 3%, but 0.3%. So here you'll have to just take the higher number. Or just take the number. You have the number there. You should be able to see it. I see it. Y'all see it, right? Or am I missing it? Y'all see it on the tape?
You said take the higher number?
Well, not in this case. You don't need to. Oh, I see what you're saying. Sorry, Luke. You're right. I can't get them both on the page though.
Yeah, that's it.
Can your eyes do that? If this is probably the column. All right, y'all got your number? Y'all got it? Anybody? All right, so let's try it out. The daily standard deviation is 2.4%. Is that high or low, do you think? What's the standard deviation of the S&P 500? 1%. So this is 2.5 times more risky than the US stock market. It's a pretty risky portfolio. Pretty risky. It's a derivatives portfolio. What's the problem with using standard deviation for a derivatives portfolio? They're usually not normally distributed at all. We'll talk about that later when we talk about options. All right, so what did you use here? Give me the numbers.
0. Deviations of 1.89.
So what was the number of standard deviations?
1.89.
189.
Oh, sorry, no, was
2.75.
2.75, yeah. And what's the next number? Before, what did you get there? 6.6?
Yeah.
Okay. What is that in dollars? 0.66 times what? What'd you get? They pass or fail? Looks like they failed. So I'm giving you something pretty helpful here that you could use with your banks. If you know the S&P has a 1-day standard deviation of 1%, when you look at your banks doing daily VARs, you might try to figure out how close they are to the S&P 500, how volatile they are. They shouldn't be nearly as volatile as the S&P 500, but you might ask that question. So 100% in stocks has a 1% standard deviation. They're at 2.4%. So this is a very levered portfolio. Again, hedge funds. So I'll just give you my example. So at USA, we decided to hedge balance sheet immunization in our pension plan. The problem was our expected return came down, and so that's going to cause the expense to go up. So I had this genius idea. Let's do a hedge fund, a long short hedge fund. It was market neutral, and let's do one. We'll put 5% in it, and I wanted them to leverage it up to 20% return, 20% risk, which means 5% making 20%. They gave me 1% extra return, was just enough to keep our return the same level. So I was kind of playing games a little bit. So I wouldn't have this major accounting loss, but instead of taking stock market risk, I somewhat bet on this hedge fund. It was uncorrelated with everything else. Usually when you do that, it's the worst thing you can do because they'll have their worst year ever. But that was my idea. I go to the CEO. There's no way he's going to approve it because he never approved anything. But on that day, he goes, yeah, if that's what you want to do, yeah, that's fine. He was like, he didn't even look at it. It's like, what's wrong? Is he sick today? So we did it, and that hedge fund had their best year they'd ever had. So we're incredibly lucky. They were up like 50% that first year. It's like, I'm going to retire, get out of here because they're not going to have a year like that. But it worked out swimmingly. The auditors bought it because the hedge fund advertised 20%. So we were able to use 5% times 20%. We got our 1%. The fund they gave us is a 1 and 1%. But we said, hey, leverage it up to 2020. We can put that in there. And then they had a great year the first year, but very, very volatile. That was annual though, not daily. 20% daily would be pretty crazy. But the S&P's annual standard deviation is about 15%. So this is a pretty volatile fund. So you can kind of play with the game and the numbers a little bit to try to get what you want. But you really got to be careful that you don't play with them so you get the numbers you want, and then you're going to find out you're eventually the numbers are going to be what they are. So, all right, that one's a fairly straightforward one. I think the next one's, this one's called Biden. That was probably before he was president too. That one looks the same type of question. So it has some answers. So yeah, they're the same questions over and over again. We'll practice some more on Thursday, give you a little more practice, but so this is out there on Canvas, so you can practice through them. Yeah, these are the same problems over and over again. equity trading desk, a prop desk. I don't know what prop desks are. Banks have their trading desks. They're not so popular after 2008, but a lot of those are daily VARs, not annual VARs. Yeah, it's the same problem over and over again. The exam is probably going to look a lot more like the ones here at the bottom. So maybe what we'll do Thursday night is I'll bring the previous exam in and we'll work those problems.
So the S&P has a standard deviation of 1%. And people are always talking about how they should hold, and like holding it over long periods of time will give you great returns. But like, are there riskier places we could put our money that would return more? Like over even?
Yeah, if you do small cap, the expected return, we'll talk about that later when you do your project, because we're going to have to assign a return and risk for each of the asset classes. Yeah. Is it always the case that higher risk has higher return? No, gold has very high risk and very low returns. But why do we buy gold? It's kind of the next topic we're going to do. Why would you buy gold? Why would you buy gold when it has an expected return of 3% and a standard deviation twice at the S&P 500? What are you looking for with gold? But exactly when you get security.
Right.
You're hoping gold, you want gold to have high volatility. Why? Because when does gold do its best? When everything else is crashing. So you actually want that standard deviation. So the low return is not what you're looking for. You're looking for diversification, especially diversification during a crisis.
If you, since you created that hedge fund to get more high returns from those, why didn't you, get like, use the leverage form of the S&P or whatever?
Well, I wanted something that wasn't correlated to stocks. This was a long short. This was actually a market neutral hedge fund. It was with Deutsche Bank. It's the first hedge fund I ever hired. We went and visited them. I was really, really impressed. No finance people working in that department. It was all mathematicians and engineers. Looked like a cool place to work. It's really quiet. You walk in, you whisper like you're in a library. It's a bunch of brainy people sitting at their desk completely alone, working on an idea they may have been working on for 6 months. They may come to their boss and say, hey, I think this might work. They'll put it in an incubator fund for 2 or 3 years, test it. I mean, it's not your typical Wall Street. It's a very quiet. It's like, don't disturb them. I was really impressed, but very quiet, very tranquil place to work. And we were just lucky that was the first one we hired, and they just happened to have a really good year. I mean, it was just really, really like, I really didn't think we'd ever get it approved. And we just caught him on our CEO on a good day, and he said, yeah, that's fine. All right, so Thursday we'll work the prior exam questions. They're going to look real similar to what we just did. I do try to sometimes on this last one, throw out a trick. So let's say the pension plan crashes and is a disaster if it loses 25% or more. What is the probability they will achieve that returns? So how would you work that in this case?
Your target would be 25%.
So here, does the negative sign matter? Absolutely, because you're talking distance from the mean. So how would you work that one? Minus 0.25 equals 0.06 minus number of standard deviations times the standard deviation. So here you can get what, 3.1? So 3.1, what's the probability you lose 25%? 3.1. It's 0.1% chance. Not very likely you're going to lose 25%, but there's a chance. The table value was 0.999. So once we get the difference between the mean and the standard deviation, you don't really care if it's positive or negative. You kind of know. Because they could have asked it, the pension plan crash is a disaster. What is the probability they achieve a return higher than this, then what is the answer? 99.9%, right? So you have to look at how, word the question, that's why you look at the normal distribution. It should be obvious. Say, what's the probability of portfolio expect to make 6%, loses 25%? You kind of know that's not going to be 99%. 99.9%. That seems really illogical, doesn't it? So it's kind of obvious to say, or what's the probability it doesn't lose more than 25%? Things say, yeah, that's probably 99.9%. Pretty unlikely. So we're probably okay. Right. I'm not going to do these other ones. They're real similar. You can read through them. I think I have the answers in them. I want to get to the second exam question. We don't have to worry about it for a while, but this takes some time, so I want to get started on it. And these are the far more interesting questions because they're more real life. We did the ones y'all just did. We did those at USAA. It was pretty common to do that for some quick analysis where you need a number pretty quickly. We did those, but these are the more likely ones you're going to see. And that is, what if you're trying to figure out how to build that portfolio? How much you're going to put in A, how much you're going to put in B, how much you put in C. So now return and standard deviation are not sufficient. We need a third number. Anybody know what that third number is? You have return, risk, and correlation. We need a correlation. That makes a huge difference to our analysis. I just mentioned that with gold. Gold tends, it's not just that it has a correlation, but it tends to have its strongest negative correlation during the time you most need it. So we have to consider correlation between assets and can be with liabilities as well. So you got to ask, we talked about with the pension plan. The pension plan is highly correlated to interest rates. So you need assets that are highly correlated to interest rates. So you can look at assets and liabilities. So hopefully y'all know this formula. You know, there's certain formulas you should know. I should make a list of them. So standard deviation, correlation, beta, those formulas you know. The duration formula you know. The other duration formula you know. This is one of those formulas, or CAPM. All y'all know CAPM. What's CAPM? Risk-free rate plus not the risk in the market, but the market risk premium times beta. Yeah, you know that formula. So you should all know this formula. Y'all know this formula. Y'all saw this in stats, right? Does this look familiar? What is this? Weight of A squared. Standard deviation of A squared. Weight of B squared. Standard deviation of B squared. 2. Weight A. Standard deviation of A. Weight B. Standard deviation B. Correlation AB. Take the square root. Y'all remember that formula? It's been a while. What if we have 3 things to allocate to? You're going to do this for A. You're going to do that for B. You're going to do this for C. You're going to do this for A and B. You're going to do this for A and C. You're going to do this for B and C. You have to do them all together. What if you have 4 things to allocate to? You got to do this for A, this for B, this for C, this for D, this for A and B, this for A and C, for A and D, for B and C, B and D, C and D. All right. How many will I give you on the exam?
2.
2, probably not 3 or 4. If we were doing this on Excel, how many I would give you? I give you a bunch. And I'll show you when you do the project, I'm going to show you how I set it up in Excel. Excel handles this really, really well. At USA, we purchased oh, I forgot his name. Ibbitson's model that did all this. And we quickly discovered we can do this in Excel. Why pay them thousands of dollars? You can build this in Excel. It's actually really flexible in Excel. At USAA, I was able to set up some stuff in Excel using this formula where I could do some really sophisticated analysis. So with 2, it gets a little cumbersome. With 3, 4, 5, you just got to set up in Excel. It's going to look like a pyramid because once we do A to B and A to C, we don't need to do C to A and C to, so you get fewer numbers each time. So what is the most important number in this thing? If correlation is 1, what do you end up with? You end up with the weight of A times the risk of A plus the weight of B times the risk of B. If they're perfectly positively correlated, you just take the weighted risk, just like you do with return, right? What's the expected return? The weight of A times this return plus the weight of B times this return. Correlation doesn't impact return. Risk, when you get the risk, correlation impacts risk unless the correlation is 1, then it doesn't. Then you just weight them and add them up. All right. Does correlation impact beta? What's the beta of a portfolio? Is it the weight of one stock times this beta plus the weight of the second stock times this beta, or do you have to take correlation? You already remember correlation on beta? So the answer is no. The beta of a portfolio is just weighted average betas. What about duration? If you take the duration of bond A times this weight plus the duration of bond B times this weight, is that duration of portfolio? Yes. So duration of a portfolio is just weighted average durations. The beta of a portfolio is weighted average betas. Standard deviation is the tricky one. Standard deviation, you have to do this last part because correlations, and you see that in your banks, right? They're subtracting out that correlation adjustment because things aren't perfectly correlated to each other. And how material is that? Let's do it. So we have time. Oh man, I don't know if we have time. How fast can I do this? Well, let's try it. May not have time. So this is something if I highly recommend you sit down with a blank Excel spreadsheet and you do this off the top of your head. All right. So we're gonna have a return, we have a risk, and we're gonna have a bond, we're gonna have a stock. Let's see if I can get the right numbers. Let's say, how would you get an expected return on a bond? Well, bonds are pretty simple. Just look at their current yield, and that's your best forecast for bonds. So let's use 4.5% there. What's the return on stocks? Anybody remember from my investment class? Expected return on stocks is blank plus expected blank. Who's in my investment class this semester? Sebastian, you should know. What is it? What's the expected return on stocks?
Oh, wow.
Current yield plus expected growth in the economy plus stock buybacks. Current yield is like 1.4%. Stock buybacks. Economies can grow about 6%. So let's use 0.85%. Standard deviation on bonds is about 5%. On stocks, let's say 16%. So let's have a portfolio. Let's say we have 100% in bonds, or 90% in bonds, or nothing in bonds. And Bill Gates thinks there's something out there, but it should be 0. What's our weight to stocks then? 0. Yeah, 0. Oops, sorry. So 0, 10, 20, 30, 40. All right. Pretty straightforward. What's our expected return? Expected return is a piece of cake. Y'all did this over and over again. We have 100% in bonds. We take 100% in bonds times 4.5% plus 0% in stocks. That was 8.5%. I'll lock those in. I don't really need, I'll lock that in. There's our returns. Growing over time. Up to 8.5% because that's 100% in stocks. Everybody's good with the expected return. Expected return is a piece of cake. Correlation has no impact on that at all. And then the expected risk. So I need one more piece of information here. Expected risk when, what if correlation is 0? All right, so. I'll start, we'll finish this the next class, so. Anybody remember the formula? That famous formula you're gonna memorize, what's the first part of it? Weight of A squared. Times what? Risk squared. Then what? Plus times minus what? Plus, what's the next part? Weight of the stock. Times what? It's risk. What's the next part?
Correlation.
Well, correlation to me, what do you start with? 2 times weight times risk times weight times risk times what? Times correlation. Raised to the 0.5. Now we're probably gonna get 5% because we're 100% in bonds. I'm gonna switch this up. I'm gonna put risk first and then return. Between Bill Gates and Zoom, it's really. Bill Gates should have known I didn't want to do that. I'm trying to save time and it's wasting me time. Let's see if you recognize this famous shape in finance. Does that look familiar? What is that? Efficient frontier, Markowitz efficient frontier, all right? What if correlation was exactly 1? Where would this line be? Don't leave yet, you got 3 minutes. Where would the line be if correlation was exactly 1? Well, it would attach these 2 points. What does negative correlation or low correlation do? Pushes your return up, pushes your risk left. So what correlation does is it gives you higher returns at every level of risk. What if correlation was -1? You're going to have a 0 risk portfolio at some point. So you can get a really strange looking. Right, we'll have to do that one next time. But there's your efficient frontier. So y'all just saw what I did. You should be able to build one of these. Could you build one of these with 3 asset classes or 4 asset classes? I'll show you how to do that when we're working on the project. All right, I'll stop it there. You got the first one worked? Let's do the first one because we got the first one. The other ones are pretty easy. So someone work this for us. Someone give me the answer on this one. Yeah, well, give me the entire equation.
0.01 minus 0.02
How much?
0.02 times 2.61.
All right. What'd you get?
Oh, 4.22%.
All right. And your answer was pass or fail?
Okay.
Agree with that? All right, work the second one.
0.012 times 2.12. And then I got 0.02544. Now this is part we have to do as an.
All right, keep working.
Didn't you, isn't it subtracting the risk column? It's not this negative.
Well, the two that have given the answer do it the exact opposite order I do it, but it doesn't matter. You can do it.
Okay.
you get the same answer either order, but yeah, I usually do the 2.12 times the standard deviation. So I'm gonna switch it back because that's how all the examples are, but, so how'd you get the dollar amount?
I did, they're 550 million times, that, yeah, I got 13.992. And then I did 550 times 0.017 for their 1.7 risk tolerance.
You wouldn't do that. No, this is all you need right here. So did they pass or fail?
Oh, they passed.
Pass. Yeah, so that's all you need there. All right, so work 3A now. Kind of the same question over and over again. And then 3B is probably gonna take you a little more time. Anybody 3A yet?
So
You got it, Alex? You wanna do it?
About 5% minus 2.17 times 8%. And then I got 12.26%,
6.3,
36.
3.6.
And then multiplying that by the 3 billion, I got 370 million.
378.
The 378,000. That's a 370.
I'm sorry, 370.8.
Yes,
Okay,
and then it's
all right. All right, so now the hard ones. Probably 90% of class misses the hard ones, which is always disappointing to me. Hopefully this class will do better. You can argue that's just bad teaching, but it can be bad learning as well. So, and the reason I say it could be is because you did this in your stats class. So it's not just, maybe it's bad stats professor, but you should, as a finance major, you should be able to do a problem with that like this, even if you hadn't taken my class. So get good at using the normal table because we do use it a lot. So try your best. I'd be surprised if anyone gets it tonight, but if you do, I'd be really impressed. So try it. Now just look at the problem. One portfolio is making 5%, one making 6%. Is your probability going to be greater than 50% or less than 50%? You got a portfolio that's make 5 or 6%, and you're trying to make 3%. Is your probability greater than 50% or less than 50%? Should be greater, all right? So you're probably not going to need to do 1 minus anything on this one. So use some logic. If you need to draw the normal curve to see how it works. Anybody got this one yet?
I think I might.
All right, Kenneth. How did you set it up? So when you're given a target, what do you do with that target?
0.05 minus 0.08 times x.
So number of standard deviations times 0.08, okay. And then you solve the number of standard deviations, all right.
I got 0.25 the number of standard deviations.
Probability was what?
5987.
So, well, we'll just keep it at that, all right. May want to do the next one? You set it up the same though, right? What do? You just change the numbers. 0.03 equals what this time? What was your standard deviation? 0.09. You might get that far.
0.33.
So a higher probability.
16.
So it's like a couple of y'all get that. How many got that one? A lot. It's less than 5% of the exam, but if only one person gets it, I'll probably make it like an extra credit problem. What would my preference be for the percentage to get it right? What would you think? I would like 100%. So they talk about grade creep. I've had a little grade creep in my class, but I don't grade any easier. It's because I require attendance, and students that don't come to class don't sign up for my classes, and there's a high correlation between attendance and grades. So I think that's part of the grade creep. I think I require attendance because, like one professor said, I'm not their mom, but it's not that. I just won't engage students. So I'm cheating the system and getting better students because I require attendance. But that's kind of my secret. The other professors haven't figured it out yet, but my secret. All right, I'll put this out there on Canvas. Questions on that? These are fairly, the first three, everybody should definitely get. They're the same question over again.
If you were to use a normal table on the last question on B, how would you go about them?
Well, you've got your number of standard deviations, right? So you're looking for 25 and 33, so 0.25, there's 0.25 right there, 5987. And what was the other one? 30, 33, so 0.33, 6293. So the main thing is, do you take one minus that, or do you take that number? That's why I said look and see. If your mean's above what you're looking for, it's got to be greater than 50%. Yep. If I said, what's the chance they make less than 3%? You have to see how I word it. If they, what's the probability they're going to have a large cash, then you would do one minus. I didn't ask it like that. I asked, what's the probability of making 3% or more? So if I'd ask, what's the probability they'll have a large funding this year, then you do one minus. So always know which side of the curve that you're going on. Some students will draw the curve, put the mean, put what they're looking for, and then it becomes obvious it's more than 50%. Yeah, this is a pretty common finance function. We do this a lot in finance, so you get really comfortable. I know we're going to read Nassim Taleb later, and he hates that we use a normal curve. He says we overuse it, but the fact that we overuse it means you better know what you're doing because we overuse it. You need to know how to do it, even though we may be overdoing it, just because we do it a lot. So it's really kind of key to what we do. I'm going to put it on Canvas right now because I'll forget if I do it otherwise. I'll put it out there under exam reviews. So we do have the exam on Tuesday. You got the exam guide. Any questions about the exam? You'll know exactly what's on it.
Oh, I have a question.
Uh-huh.
Do you have the updated, rubric for?
I thought I put it out there. It should be the correct, this is the correct one. Yeah. It's smaller print because I went longer on the typing, but yeah, this is the correct one. So you know exactly what's on the exam, and the essay is open book because you're going to submit it by Word. I do check plagiarism, so make sure it's your own work, that you're not copying someone else's answer. But it's there. You got my blog. You don't copy and paste from my blog either. That won't help you at all. I do tend to recognize my own words. All right. So last class we were doing this efficient frontier. We can make it look more like an efficient frontier by forming our axis a little bit. Then it looks more like an efficient frontier. So that's an efficient frontier, and it's what it's telling you is our expected return at every level of risk. We have risk here and return here. Do we have actuary majors in here? Can't remember. Any actuaries? So actuaries do it backwards. They put risk here and return down here, but we put return down here and risk up here. If the correlation was 1, we talked last class, so the correlation is 1, then it's just a straight line from here to here. Let me see if I can do that for you. It's a little tough to get this to fit in there. So correlation is 1. We can use the exact same formula we did before, except where we use correlation of 1 at the end. What I'm not sure of is how I can get this into the graph, but we'll see. Not sure that's the right way, but we'll see. That looked like that messed it up. So that's not a correlation of one though, so that doesn't make sense. Yeah, I always have trouble with that, and we just lost Excel. Don't know how that happened. All right, but just trust me. Let me copy this there and so if we change this to a correlation of one, you're gonna get an absolute straight line. Okay, Bill Gates doesn't know how to do this. So anyway, if we change it, I'll just do it in here. It's just Bill Gates doesn't know what he's doing. Then it just becomes a straight line. And you'll see where it went. It went from here, it shifts down. If you change it to one, it just shifts down. Everything just shifts down, all right? I wish I could put all three of them there. It takes me a while to do XY graphs with multiple values, but just a straight line. So there's no benefit. There's no diversification benefit. It's just a straight line. Your return's a straight line. Your risk is a straight line. Now the special case, and I don't know if I set it up right because I can get a non-value. It's possible I have a formula that doesn't work because you can't take a square root of a negative number. We'll try this. What if it's -1? And if it's -1, we'll see. It might get a wild valuation. Yeah, it didn't quite work. When you have -1, it goes out and you actually will have a point at 0 risk. If two things are perfectly positive and perfectly negatively correlated, there's some point where there's no risk. And so here's a trick question. See if you're paying attention in Catapacum's class. If your risk is 0, what's your expected return? Don't say 0. If your risk is 0, what is your expected return? Risk-free rate, right? So if your risk is 0, you should get the risk-free rate. Y'all were debating earlier if there's a risk-free rate, all right? So there is a 0 risk portfolio out there. It should be the risk-free rate, but there's a lot of debate about if there even is a risk-free rate that exists out there. Robert Arnott has some really good, interesting discussions about the risk-free rate, but the 0 correlation kind of curved here and went this way. The 1 correlation is a straight line, but as you can tell, what correlation does is it shifts your risk to the right, and then your return is higher at each point. It's somewhat magical, but 0 is the one we're used to looking at because that's the normal way we see the curve. I'm going to fix the axis again. Maybe Bill Gates will let me keep it this time. And who invented this thing? Harry. Starts with an M. Harry Markowitz. He passed away just like a year ago. It was really strange. I think it was last year. I had been asked to do a lot of presentations, and I had Markowitz and I had another guy. I can't remember his name. So for the presentation, I look them up to see how they're doing, and they both just died right before the presentation. So it's like I'm not putting anybody else in the presentation, but yeah, Markowitz invented this in the 50s. If you read Peter Bernstein's Capital Ideas, he explains why Markowitz had to come before Sharpe, and he gives you that history. And then he had to talk about why did Markowitz and Sharpe have to come before Black-Scholes. As you look through those and each one lining up versus the other, they each were adding something a little different. My question is, how did Markowitz do this in the 50s? Because he didn't do this with asset classes like we're doing. He did this with every stock versus every other stock. So 500 stocks, he needed expected return, expected risk, and he needed a correlation between stock A and the other 499, stock B and the other 498, stock C. And what kind of computer power do you have in the 50s? You had slide rules. You didn't even have calculators, right? My dad bought me a Texas Instrument calculator in the 70s, and I thought I was the most advanced. And it probably cost a few $100 in today's dollars. It was pretty cool. It was a really, really nice calculator. But Markowitz didn't do that. I mean, how did he do that? So they probably didn't do much history, maybe a year or something, very, very little data because it was just so much work. But somehow he did it. He probably had a bunch of PhD students just in there calculating constantly. So who knows, but that's how he came up with. And then what does Sharp say? You don't need to do stock A versus the other 499 stocks and stock B versus the other 40. What did Sharp say? Yeah, just do each stock versus the market. Then you eliminate all. So he reduced the calculations quite dramatically. And then he said, wow, you notice about 80% of the risk disappears when you do that because 80% of the risk of a stock is company specific. So all this lines up, it makes sense. I've always thought we should teach finance chronologically versus the way we do it, where we throw it, because each one is a pillar that builds the next one up. So there's your efficient frontier. If we wanted to add more asset classes, we would have to do this formula. We'd have to do this formula for each asset class. So if you have 4 asset classes, you'd have to have this 4 times. And then you'd have to do this with every possible combination between the assets with the different correlations. So it can get pretty cumbersome. You'll see how I set it up when we do the project, because it's set up to do that. So my challenge to you is build what I just built. You'll probably do better than I did. You maybe can get multiple curves in there, but build what I just built. No notes, nothing, just sit down in Excel and build it. It is an important function to have. You'll notice when correlation is like 0.8, it really looks like a straight line. That's what you're going to notice when we do the project, because most asset classes, especially stocks, US stocks versus international stocks and emerging market stocks, the correlation is in the 80 range. US large cap stocks versus small cap, the correlation is like in the 90s. So you start seeing there's just not much benefit. There is some. If I could put the 2 lines, there's a little bit, but it's not massive. And this is part of the challenge with the efficient frontier. When you do the project, it's going to tell you this is the best portfolio. What it's not going to tell you is that there's another portfolio that's practically exactly the same, that's radically different, that you might be easier to sell than the one you came up with. And so that's the challenge. It's very, very, very sensitive to the inputs. So there is some challenges to it, but you can see how you can use Excel to do this for you. You can build these things in. All right, the more complex problems. These are the more realistic ones, especially when you're dealing with asset allocation. Some of y'all may work in a strategy department. If you work in wealth management, you want to get out of wealth management as fast as you can and move over to the strategy side or the portfolio management side and get out of the sales side. We had a meeting today about the SIE exams. So we're going to start and have a great idea for the investment society related to that. But there's a lot of this efficient frontier on the exam, probably in much simpler format, but talking about the importance of correlation and diversification. So there's some important things to remember before we get in these problems. When correlation is negative, you actually want more risk, because that means it tends to be going the opposite direction of everything else. So when everything else is going down, you want this thing going crazy up. So gold is the thing we usually talk about, but not just gold. There's another asset class. What asset class really killed it in 2008? Where would you want to be 2008? What kind of treasuries? Long-term treasuries, up 60%. So that says, what's the perfect asset class? How did they do in 2022? And the stock market was, so in 2008, stock market was down, long treasuries were up. How did it do in 2022 when the stock market was down 20%? They were down 30, 40%. So oops, they did really well. I'm going to show the Investment Society article in The Economist right after my presentation last week was on correlation. And then The Economist had almost the same article, and they said, wow, it's interesting, stocks and bonds are suddenly more highly correlated than they've been in the past. And it's like, yeah, why? Because of inflation. They don't help you in inflation. But if they're consistently negative, so that may be something to put into your notes. If they're consistently negative, then that's great. You want more risk. However, I'm going to show you some articles. They're not necessarily consistently negative. No asset class is perfectly negative all the time. So gold has really low return. In fact, what is the return on gold? It's essentially, most people just say it's inflation. I know gold's done great. It's the highest returning asset class this year. It's just doing really, really well. But over the long term, gold hasn't done all this particularly well. It's essentially going to move with inflation. That's not a very high return. Has a high standard deviation, more risky than stocks. Why in the world do you buy it? You buy it because it's going to protect you. I'm going to show a presentation a guy made at the CFA luncheon. He was pushing pretty heavy gold allocations that would have been pretty crazy, I think. But low correlation means risk reduction, but relies heavily on reliability. Just because two things are uncorrelated today doesn't mean they will be the next crisis. And during a crisis, correlations can move in unexpected ways. Risky assets tend to all move together in a crisis, which is the worst thing for you. And then other times, like we're talking about with treasuries, they can help you a lot in a crisis, but kill you with inflation. So sometimes they help you, sometimes they hurt you. I'm going to show you the Bridgewater article. It's not on Blackboard though. On Canvas. They say in the article, correlation does not exist. So that's kind of a strong argument. They're throwing out the bulk of the finance in one sentence. So that's kind of strange. And then an essay for the second exam is another blog. It's about as sacrilegious as you can get. And I asked, does diversification even work? And we'll look at that and we'll see, you can see what my conclusion on that is. All right. So let's try some more complex problems. I think I put some out there. Let me see what I put on Blackboard. Well, here's the Bridgewater article. Let's start with this because we're going to talk about this. So once I kick out the idea of correlation existing, I'm not going to leave you high and dry because I'm going to show you two alternatives to correlation. So if you look at what they're saying here, so this opening, the global financial crisis providing good test case for portfolio and risk management. One of these is the consensus approach to correlations, which we think is deeply flawed. Have y'all heard of Bridgewater before? So supposedly a horrible place to work, but if you like, a lot of people, stabbing each other in the back to get ahead, it's a great place to work. We think is deeply flawed and has caused problems. The past decade shift in stock bond correlations contributed to severe deterioration in the funding status of pension plans. We've seen that. After decades of positive correlation, stocks and bonds became negatively correlated as stocks fell and bonds rallied. This shift hurt pension plans because their assets are concentrated in equities while their liabilities. That sounds familiar, doesn't it? Why is that such a big deal? Well, the stocks and bonds are negatively correlated. So stocks are falling and bonds are going up. What are the liabilities? They're essentially negative bonds. So they're also going up when stocks are going down. The spike in correlations across risky assets eliminated diversification, which contributed to higher risk in institutional portfolios than they were telling their clients. At a broader level, the correlated exposures within and across bank asset portfolios has contributed to damage to financial systems, the global deleveraging, and to the potential financial crisis collapse. This is an older article, so he's talking about stuff several years ago. But here's their sentence. We have a different view. We believe that correlation does not actually exist. Now they say as an inherent characteristic. What they're saying is assets don't have correlations. You can calculate correlation, but that's just for some period of time. But that doesn't tell you anything about what's going to happen going forward. That just happened to go up in there. Correlation is a statistical artifact reflecting how things happen to turn out, which provides, this is pretty heretical, little or no insight to future relationships. Most firms that you work for that do efficient frontier, their correlations are entirely based on history. And they're telling you history is not reliable. Just because two assets have moved in a certain way in the past doesn't tell you how they're going to move in the future. Correlation is simply how two assets correlate with one another. Understanding correlation requires an understanding of the nature and causes of asset returns. Basically, what they're saying here is it's not correlations, it's environments. And we're going to get into that in the blog. It's not correlation, it's environment. And so I'm going to give you two approaches. I want you to think about this as we get into this more difficult problems. What are the environments? There's growth versus recession. There's stable versus risk. And there's low and high inflation. Uh-huh.
I think you missed the word not between the it's and quote.
Oh, sorry. So Bridgewater is saying, forget correlation, think environments. The other presentation is similar. He has a different group. So let's just think stocks and bonds. You have a strong economy. How do stocks do? Oh, how do bonds do? Might be falling, right? Because interest rates are rising. So here we have a negative correlation in growth. How do stocks do in a recession? How do stock bonds do in recession? So negative in recession. Perfect, right? That's what you want. How do stocks do when everything's cooking and doing okay? No big concerns. Negative and stable. Bonds aren't all that great. What happens when the world's falling apart? There's some big geopolitical event. Russia attacks Ukraine, China attacks Taiwan. How are bonds going to do then? Negative in a crisis. Perfect. And that's the majority of Americans. Let's buy stocks and bonds. And that's all they need. And we're diversified. And they are. 2 out of 3 times they're diversified. How do stocks and bonds do in low inflationary? Positive and low. How do they do in high inflation? Positive and high. Whoops. That's the 2022 where they're both down over 20%. Stocks and bonds both down 20%. So are you diversified? If you have stocks and bonds, you are, except for when there's inflation, you're not diversified. So that means most Americans in 2022 were poorly diversified. Although a lot of Americans, their biggest asset is their house, so maybe they were okay depending on where they lived. A house is not an investment. A house is an asset you live in and it depreciates. If you think a house is a good investment, then you're probably leaving out a huge chunk of the cash flows. A house is a terrible investment. So if you really put the numbers down, I don't think people realize that when you buy a house and live in it for 30 years, you buy the house 2 or 3 times. Water heaters, air conditioners, roofs, fences. The house is an extremely expensive asset. You got property taxes. So it's not a great asset. If you could buy houses throughout the entire world and diversify them, you know, maybe you're renting them out, maybe you can make a good asset. You're seeing BlackRock doing that. But it's hard to say that having one house on one block in one city is going to help because it's not very well diversified from that standpoint if you're in the wrong city. But that's for most people outside of their residential real estate, most people, their entire investment portfolio is stocks and bonds without much diversification. So you're going to see with the other presentation, that's also the way he did it, but with a little bit different definition. So he says, discussed and so last week, we believe that the returns of assets can be well understood by viewing them in terms of what we call all-weather lens, mean a perspective that views the pricing of assets in terms of discounted economic scenarios. So what scenario are you in? Following charts show our assessment how discounted growth, discounted inflation, and risk. So he's seeing if they have growth, risk, and inflation. Growth has to do with the economy, inflation has to do with inflation, and risk has to do with these kind of out of left field kind of big risks that just hit us all at one time. Like 2008, like 9/11, those type of things. The charts on the left show the contributions of discounted growth, inflation, and risk premiums. Essentially, what they're trying to show is that their model does a better job than a constant correlation. And to show that you're better diversified. I won't get into them there. So that's their approach. I give you another person's approach. I think I give you their entire presentation. The CFA presentation, I'm kind of going, we're going to come back to this, but I want to set up why correlation is somewhat debated. I don't know if this guy's still around. Huh?
Do companies, like, do they do this now?
Oh yeah, it's still pretty common, yeah. Well, it's do this or do the old way with the constant correlation.
Old way and versus the new way, which one's?
Well, the constant correlation is still 99% of the approach. Yeah, that's what you're gonna do on your project. It's the approach, it's a stable correlation. And people just like hear no evil, see no evil. Because they have to, WOAI, there's a firm called the Mutual Fund Store. And their advertisements came on and they were talking about how they use sophisticated modern portfolio theory, which is what? Constant stable correlations. It's exactly what you're gonna do your project too. How sophisticated is that? It's very sophisticated in 1980. In 2022, I don't know if it's all that sophisticated, but yeah, notice that's most wealth managers, most big, UBS, most of them are using something very similar. The one exception that you'll notice with firms like Financial Engines and those is they'll do stochastic analysis. So they have instead of having one set of assumptions, they'll run simulations. But the question is, do their simulations actually change correlation? So at USAA, when we did this, I had constant simulations except in the tails. So what I told the model to do is if it's a tail event, like an extreme event, I want everything moving together. I don't want diversification benefit. So if large cap stocks are down 30%, I want the small cap down 35. So I had the market have it and the tails do some different things. So I don't know if this guy's still around. My sense was he was about to retire and he thought this was a great market. So he's going around telling everybody, this is really great stuff. Before I leave this profession, I want you to know about it. It was a good presentation. So you have it. It's a little old. He breaks it up like this. Increasing anxiety with a strong currency, increasing anxiety with a weak currency. He's talking about currency. Currency is closely related to inflation. So he has a little bit there. Diminishing anxiety with strengthening currency, diminishing anxiety, weakening currency. Here he says when people are worried and the dollar is strong, which means what? Is the dollar strong with low inflation or high inflation? With high inflation or low inflation? Low inflation, right? Currencies, if you have inflation, it's destroying the value of the currency. So this is pretty good, right? People are worried, but there's not much inflation. Bonds are a good place to be. Increasing anxiety with inflation, where do you want to be? Gold's a great place to be. When people aren't worried and inflation is not a problem, domestic stocks are a great place to be.
Wait, say that again?
When people aren't worried, everything's doing well, and you don't have inflation, US stocks are a great place to be. When everything's fine, but your currency is weakening because of inflation, you want physical assets like real estate, commodities, or you want non-US assets. All right, so that's his argument. You notice gold has a huge place in his portfolio. That's something I talked to Investment Society. Gold did horribly in 2022 when we had inflation. Why? Because the dollar was strengthening. So my question is gold really belong there? Maybe there's a commodity like oil or something commodity related that belongs there along with gold, because gold has not performed well. And then TIPS didn't do well in 2022. You would think inflation-linked bonds. Anybody remember why TIPS didn't do well in 2022? I've told some of y'all that story.
The yield for them.
Yield for.
We had a negative real yield, so those are bonds. They're priced off the real yield. When the real yield goes from negative 1% to positive 1.5%. So I think right now tips are probably a pretty good inflation protection because the real yield is pretty high. You give you good protection, so they're back in the game. But he doesn't have tips in his. But what he does, one of the things I really like his chart is he shows historically how different things have done in these different markets. Whether you have a growing economy or a decelerating economy, you have inflation. He does each one to show, yes, there are times when stocks and bonds are really good hedgers to each other. You can see here plus and minus, minus and plus. But there's other times when they're not good hedges for each other. So very, very similar. The difference here is how he brings in, he has gold, but he has other fixed assets separately. And I really question that. But part of the problem with his model is how much he puts in the gold is most people couldn't tolerate that. That would be a really, really volatile portfolio. So that's part of the challenge, but it's an interesting presentation. So we'll get into that a little bit later. I got to find, hopefully I got these problems out there. I thought I put them out there, but hopefully they're out there. But I'm not seeing them. Oh, there it is. Okay. All right, this is it. Let me show you how these questions work. These are really, really good questions because they're very, very real life. So, and I'm running out of creative ways to write these. So when you work all the problems, you're probably going to get every trick I can pull because I've run out of tricks to play. I wish we could take this exam on Excel because this one really lends itself to some optimization kind of routines, but we can't do it in Excel. But let's look at it. These are very realistic questions that you could ask in an actual job. So you're recommending a change to an existing portfolio. You estimated your VAR is 100 million and you have a risk tolerance of 0.3%. We won't talk about how we got those numbers, but you'll see some of the risk tolerance, especially where did that come from? Your boss says they want to reduce the VAR below 70 million. Who knows why, but for some reason, while maintaining and improving expected return. The highlights don't come into the question, so you got to create your own highlights, but you're looking at what is the objective. So your boss says, I want a lower VAR. Really, I'd like it below 70 million for some reason, but I don't want you to kill return. Well, that's a big order. I want the same or higher return with lower risk. Well, you always want that. So how can you do that? Well, you're going to look at a new strategy, either strategy A or strategy B, and you're going to leave 90% in the current strategy and add 10% to A, or leave 80 in the current strategy and put 20 in A, or 90 in current and put 10 in B, or 80 in the current and put 20 in B. All right, those are your choices. You're using parametric VAR. What does that mean? So let's look at the different definitions. That didn't show me. Parametric. I saw it a second ago, but all right, here it is. So on your case, you'll do parametric and historical. I don't know how to get stochastic in here, but we'll do these two. So there's 3 ways to do VAR. This might be something as you're writing your paper 1 to maybe try to figure out which way your bank is doing it. So a lot of banks do historical VAR, which is pretty common, but parametric VAR just uses the normal curve, just like what you've been doing. Mean minus the number of standard deviations times standard deviation. So you're just using a formula, pretty straightforward. We'll see on the project historical VAR, you simply look at historical periods, and based on how your portfolio would have done, you figure out the 1%, 2%, 3% case. So if you're looking over 200 days, the worst one's your 1% case. So you look at 200 days, you line them up from best to worst. That second to last one's your 1% case, because it's 1% from the end. That's historical VAR. Stochastic VAR is when you're running simulations. You can imagine what AI is being done with this, but you're running simulations with multiple kind of returns, risk, correlations, those type of things, and running different models. Actuaries do this a lot. Finance, we do this quite a bit, depending on what kind of model you have. So I don't know what UTSA has, but Crystal Ball is owned by Oracle. Do y'all use that? Have y'all used Crystal Ball in here? That sound real, right? I don't know. What does UTSA have? The other one is At Risk. That's a Microsoft product. Any of y'all use At Risk? So those are the two most common ones. I'd recommend get some experience with one of any of y'all use at your firm or somewhere. What do y'all use for simulation? What does UTSA offer for simulation? You can do it in Excel, right? But it's pretty clumsy in Excel. How much does Microsoft's cost? Maybe you should buy one. I don't know what the cost is, but do they tell you how much something costs? Advanced risk analysis. We are in the change making money or taking a loss. At Risk, a flagship. Analytical solutions perform risk analysis using Monte Carlo simulation. Tells you everything about how much it costs. So someone figure that out. But yeah, I don't think it's a fortune. It might be similar to buying another Microsoft product, a couple $100. So it would be worth getting on your resume. At USAA, we had a firm build us one, mainly because we needed actuarial backing. So we had a firm build us one that we used, and I loved it. I thought it was great. The first time we got it, it was great because AIG came to us with a product, and it was a tax product. Its whole purpose was to save taxes, but the IRS says you can't do something where your only reason for doing it is to save taxes. So they come to me and say, Ron, prove that this is valuable to USAA other than taxes. It was a CPI-based product, supposedly hedging CPI. So I ran it. This is my first test of this model. I ran it through this model. Inflation is not serially is not uncorrelated over time. It's serially correlated. So inflation one year correlates to deflation next year. So to build all that in, I ran it. I ran thousands of simulations. I come back and I tell AIG, yeah, it does protect us from risk, but you're charging us 100 basis points, and it's no way it's worth more than 10 basis points. And so I blew the whole thing because it's like, I don't think it's worth it. And so now we don't have a reason for it other than the tax benefit. And now the head of the tax department's mad at me. It's like, you asked me to go test it, and I tested it, and it doesn't work. AIG didn't think we could figure it out because they didn't know we had this tool. And so they were kind of shocked when a bunch of hillbillies in Texas figured it out, but we did. And the guy was like, yeah, it's not worth that much, but you weren't supposed to figure that out. Now you've lost the tax benefits. So it's like, if I'm going to be on court and interviewed by the IRS, I want to make sure it's correct. So we had our own model. It was incredibly powerful. Probably saved USA $1 billion in 2008 just by itself, because that's when we decided to hedge the pension plan, and it really ended up saving us a bunch.
So I found it.
Yeah.
It's not really a couple years, but essentially the cheapest that you can get is like 1,500.
Oh, that's pretty expensive. All right, so your firm might have. Well, UTSA should have one of these. So someone contact. Y'all don't do simulation in any of your classes. So Crystal Ball is probably more expensive because it's owned by Oracle, and Oracle doesn't do anything cheap. But you could create your own. Certainly you could in Microsoft. For March Madness, I have a simulation model that creates my first round of teams, and it does as well as anybody else's model. It has the probability of a 16 beating a 1 and a 15 beating a 2, and it runs the simulation. I set that up in Excel just using random numbers. That's pretty easy to do. What gets tough in Excel is when you want to bring in correlations and other things. It gets really tough to set those kind of things up. But we'll see how my March Madness does this time. But if you can get a firm, if your firm has one of these, certainly see if you can use those. So stochastic, pretty good stuff. It's pretty powerful. At the time I was using it, it's extremely time consuming. So I would kick it off on Friday. I would be tied to as many computers as I could get. I was begging friends around the office, if you're not in this weekend, can I, send some of this to your computer? And Monday morning I come in, it would still be running Monday morning. I come in and check it over the weekend. I'd pass one of the life actuaries and he was running his model and is like, we're like hardly saying hello to each other because we're so tired. But yeah, these are extremely, now today I'm sure they're getting much, much faster, much, much more sophisticated. But you're looking at the entire firm, looking at simulations. So it's the more sophisticated way to do it. We talk about property casualty class. You see really sophisticated here. When you talk about cat modeling. So Air Worldwide. This is a firm that does simulations of hurricanes, earthquakes, terrorist events, pandemics, you name it, weather events. They do all kinds of stuff. Very, very sophisticated. It's a great website, but yeah, USA uses them. Just really, really powerful stuff. Theirs is probably a little more expensive than at risk. And then the other firm is RMS. Oh my word. So RMS is owned by Moody's now, but
I think Nationwide does capacity modeling too, like when the hurricane happened in Florida.
well, they're probably buying it from one of these firms. Yeah, USA uses both of these. Air started off at what? Hurricanes or earthquakes? What do you think? They're named Air. What do you think? The hurricanes. RMS started off as an earthquake, but they now do. I mean, it's really amazing to look at what risks they actually model now. A lot of these you would think, how can you model terrorism risk? How do you actually do that? But they have data and they do run the data. They have a list of risks that they model, and that's pretty amazing. So probably something that you worthwhile to put into your toolkit if you can find a way to get it without it costing a fortune. Maybe 20 of y'all get together and buy one rat risk and just all share it together and learn it. I thought UTSA used to provide at risk for free as or part of your student fees. So what you do with one thing I love about stochastic is you start with the current situations. So these models are fairly sophisticated. They look at the yield curve, and based on where the yield curve is, how steep it is, the shape of it, they know historically what that yield curve is telling you. And so what the yield curve is telling you, that scenario is more likely to happen. So if it's inverted, you're more likely to get a recession, that kind of thing. So a lot of these other models like historical just looks at historical period, but it's not considering where you are today. And then parametric just assumes things are same all the time, never changing. So stochastic gives you a better starting point. You can put reversion to the mean, right? If you think something's really been running, it's pretty expensive, you can give it different numbers, or they will actually run reversion to the mean. So if they have a scenario where stocks do really well for 5 years, they'll make them do less average over the next 5 years, kind of thing. So they're fairly sophisticated models. Your banks are probably doing a combination of all three of them, but probably a focus on historical and stochastic. Insurance companies are very stochastic based. That's what actuaries love models. They love running stuff that no one else can possibly understand, that take hours. That's just their fun that they like to have. All right, so we're doing parametric, but some of my answers do have stochastic and historical as the third question. You'll see so you'll have to be able to, you don't have to run a stochastic model during class, but I'll give you the output of one and you'll answer questions about that based on what you did, but you'll always do parametric. And so what we're asking is which of these asset classes, which of these investments is the best one? So our current portfolio has a return of 6%, a standard deviation of 6%, and its correlation to itself is 1. Strategy B has the same return, but lower risk but high correlation to 1 or 0.4. B has a 7% return, much higher risk, but negative correlation. Now, what did boss say on return? The same or higher. The nice thing about return is just the weighted average. So you know, if you combine current with A, you're going to get a 6% return. If you combine current with B, you can get 90%, 6%, 10%, 7%. So that's pretty easy to get. So with A, you get the same return, but not better. With B, you'll get a higher return. Which of these do you think will reduce your risk the most? Putting money into A or putting money into B? A has lower risk, but high correlation. B has higher risk, but negative correlation. What's your gut feeling tell you? B. All right. So you're probably going to kind of guess on the exam. I'm going to try to find one where it looks like that's the right answer and it's going to be the other one. We'll see if I can trick you. We could do both A and B. So that may be the question. Why don't we do 10% in A and 10% in B? But we're missing a piece of data to do that. What's that piece of data? We don't know. What don't we know? The correlation between A and B. So we can't do much with A and B. Can you back into it? These? Not really. So we can't do that. Why are we doing A and B? Well, these are hedge funds. You don't go to hedge funds with 50, 100 million bucks. You got to go with more money, and it's a hassle to have more than one. It's just part of the nature of these. You might find the optimal solution is to do 40% in B. And we'll look at that. We can do that. We can see is 40% in B better than 20% in B. But the other thing we don't like to do is have too much money in one hedge fund. But you may be wondering who gave me these numbers, 6%, 5%, and 0.4. Where did I get those? Probably based off of history. Talk to the hedge. What is a hedge fund manager going to tell me? Are they going to skew things to positive or to negative, do you think? Probably going to oversell it a little bit. This guy says he's really, really good, but risky, but we diversify you. Where do you get this 0.25? Probably based on history, looking at the fund. One of the hedge funds that I hired had very limited history, but they had a lot of back-tested data, which I knew was a little tricky. Back-tested data, can you really trust that? It's a little tricky. I was talking to a friend of mine who went to Johns Hopkins at University, a really sophisticated university. He was in graduate school, and they were doing these type of models in class. And he was trying to get all the other grad students, join me, let's go to the Bloomberg lab and let's test some of these and see if they work. And they're like, no, we don't want to do that. And he was pointing out in class, it's like, you really can't do that in real life. What you're trying to do, because as soon as you execute that, the whole trade's going to mess up because you're going to overwhelm the market. It doesn't work. And the students like, we don't care. We're here for grades. We're here for degrees. We don't care if it actually works in real life. He was so frustrated. He's now running a hedge fund, but he was frustrated he couldn't get them to be interested in it. All right, so what formula are we going to use? Any guesses? Can someone give me the formula? Let's do 10% in current. I mean, sorry, 90% in current and 10% in A. What's the formula for return? 0.9 times 0.06 plus 0.1 times 0.06. That one's pretty simple. What's that going to equal? Any guesses? 0.06. Return's very, very easy. What about risk? Any takers on that? 0.9 times what?
0. No. 1.
Weight squared, risk squared, plus weight squared, risk squared, plus 2 times weight times risk times weight times risk times correlation. All right, got it. So what is it? 0.9 times what?
What's the standard deviation of the 0.91?
Standard deviations are 6 and 5.
Okay.
So 0.9 times what? Weight squared times risk squared plus weight squared times risk squared plus 2 times weight times risk times weight times risk times correlation. So 0.9 times what?
Whatever it is.
0.9. You gotta square it times what? Times what?
I'm 0.9.
0.6.
And then is it plus or times? Plus, what's the next one? Weight times risk plus weight. What's my weight?
That's.
Times 0.5.
Times what? Plus what? Plus 2 times weight times risk times weight times risk times correlation times what? Plus what? 2.
Wait, why is it 2?
Just think back. Remember you did the foil in high school? You remember when y'all did that? First out in last. So that's what that is. That was back like 6 years ago, but it was like 50 years ago for me. So y'all should remember. It's 2 times what's the weight? 9. What's the risk? Times the weight. What was the correlation? 0.4. Should you memorize this formula? No, you should know this formula. This is a formula every finance major knows backwards and forwards, all right? If you didn't get this, you still got this in stats, but your stats professor may give you a formula sheet because he wanted you to fail in life, but I don't want you to fail in life. I'm not going to give you a formula sheet. You have to know this formula. We use this formula massively in finance. Assuming this thing is what? Is constant. Assuming this thing is constant. It's a huge flaw. We'll talk about that, but
I really don't understand what the 2 came from.
I'll show you in a later class. Yeah, it's
Is this for portfolio variance?
this is the standard deviation. This is the standard deviation of a portfolio of 90% current and 10% A.
So you have portfolio variance until you did the square root at the end.
Yeah, it was variance, and now it's when I do the square root.
And then the 2 is the covariance between.
No, 2 is not a covariance. Point 0.4 is the correlation.
But the 2 comes from, like, you get the correlation between current and A, and then between A and current, it's gonna be the same, so.
I'll show you, if you think my P&C class, we actually talk about the 2. It really is taking 2 parentheses and you multiply them together, and when you do the math, you come up with 2 times the rest. It's just, right? You got A squared plus B squared plus 2 times A. You remember that? It's been a while, so I'll show you all later. We're out of time, but you've got to know this formula, not for this class. You got to know it for life. So learn that formula and just know it. All right, we'll stop it there.